Markets tumbled yesterday as the 10-year Treasury yield hit a one-year high. Big tech got slammed. Microsoft lost more than 2%. Alphabet, Facebook, and Apple each losing more than 3%, while Tesla lost more than 8%. Joining us now to put the sell-off in perspective is Liz Young, Director of Market Strategist at BNY Mellon Investment Management and a CNBC contributor, and Paul Hickey, co-founder of Bespoke Investment Group. And I'll start. Sorry, Liz. I already mentioned Paul earlier. His ears might have been burning. Were you watching, Paul? Did you stick your chest out with pride? Did I already mention a couple of your points? Good job.
Yes. Yeah. So you took the words right out of my mouth there. We've seen throughout since 2009, the average yield on the 10-year Treasury has been 2.3%, and we're now at 1.5%. So I think you can really see the market handle higher rates. Sure, we got here in a rapid pace, and that causes temporary dislocations in the market, and people have to adjust. But overall, I think the market can withstand this, and it's an adjustment process. We've seen three other periods over since 2009 where we saw a rapid steepening of the yield curve like this. And as just around this point, when the yield curve steepened over 75 basis points in 6 months, you saw a short-term period where the market pulled back 5 to 8%. You saw it in June 2009, you saw it in February 2011, and then you saw it in August 2013. So I think in that respect, this isn't to be that unexpected here.
Liz, I don't think you disagree. In fact, you're saying embrace the volatility. It was to be expected if rates rise a little, and that the power of the reopening is going to assert itself. And what you think that things like this should be used to add to the positions that you're recommending?
Yeah, I think we have to look at it from a perspective of the market can withstand this in the sense that there's probably a short-term pullback, and I don't necessarily think it's over. There's likely more to come. I don't think the rate rise is over, but rates should be rising. And if we're expecting an economic expansion, we're expecting a resurgence of demand, rates should go up, inflation should reinflate, different sectors of the market should win. So this is a transition that we're going through, and that's why I say embrace the volatility. We have this little correction, and then we move forward, and I think the market can find its footing on the other side, but we have to hand that baton from the regime that we're in to a new regime of economic fundamentals that are hopefully better at standing on their own 2 feet beyond the pandemic, and that's something that we're expecting to see more in the second half of the year. Well,
that sounds like you're maybe recommending a slight shift away from growth and some of the leaders that we've seen in the stay-at-home sector. And now are you now recommending value or cyclicals or something?
I mean, like everybody else, I do think cyclicals have a good landscape here to perform well through 2021. But I wouldn't abandon growth. I think it was a pretty classic sell-off yesterday, and I think that it's to be expected as rates rise. Growth suffers as rates rise above the dividend yield of the S&P, which they did intraday for a minute yesterday. The entire market sees a little bit of a correction because people are wondering if there is another alternative. But I do think that growth stocks can continue to add to returns throughout the year. It won't be as big of a dispersion as it was last year, but they'll continue to add because our economy is different. Our economy is still driven so much by growth and so much by technology. Technology has its tentacles in everything. So growth is not going to leave the picture. It just won't be the big standout like it was in 2020.
Shepard Smith here. Thanks for watching CNBC on YouTube.